Good evening. Tonight is the continuation of Chapter 21. Chapter 21 is quite a heavy chapter, so especially since we had a quiz last week, it was pretty impossible to do 21 in a single, just 2.5 hours and 15-minute lecture. So I split it into two. So we did a good chunk of it, about half or so last week, and then I'm going to do the second half tonight. We should be done a little bit early. I'm expecting to be done around 8:30 tonight. So next Tuesday is quiz 4, which is the last one for the term. Not all chapters. It's only on chapter 21. Not all chapters are going to be quizzed because there's a rule that you can't have quizzes or in-class stuff within the last 2 weeks of lecture. So next week is the third last lecture of the term, and so that's the last one that I can have a quiz for. So it's only going to be 21 on that quiz, but there's still, it was hard to make a quiz with just 17. There wasn't that much material, but there's plenty of stuff to do out of just chapter 21. So, as always, suggested exercises. I'm hoping that, how many of you here are using it? That's good, because we did put quite a bit of effort over the summer, me and the TA, to type out all the solutions. And there's still, if you ever see stuff in there that's not quite right, let me know by email, because we started with the instructor solutions manual, but it was so not that great. So we started with that as our base, but we've been polishing it over and over again over 3 or 4 terms. But there might still be an odd thing here and there where maybe the way that the solution's written is not quite clear. If anytime that a student reports something, I just go and rework the solution, rewrite it a little bit, make it more clear if I can. Still, the textbooks on reserve at the library, and then as far as, if you're here, you probably don't care that much about the video, but yeah.
Do you know already what chapters are going to be on the final exam?
All of them.
Okay.
Great. Whatever, so it would be 2, 10, 11, 14, 15, 16, 17, 21, 22, 23, and evaluation. Yeah, I don't do these like half finals. I think you guys call them cumulative, but yeah.
Is it reasonable to assume that you're going to focus more on the last chapters?
A little bit more, not that, maybe like 2/3 of the questions come from the second half. Like, it's not like just like a sprinkle of a very few questions from the beginning, like, because there's still chapter 16 was on the midterm, and that's a chapter where there's quite a bit of material in there. So there's going to be definitely stuff out of 16 in there. There's definitely going to be stuff out of 15. 10 and 11 are the two main chapters of the first half, so that's going to be on too. I probably won't. Chapter 2 is more of a review, kind of a to chain from 2504 into 2505. There's probably not going to be a whole lot out of there, but you need to understand a lot of the concepts out of there because they're used in the future chapters, like stuff like cash flow, net working capital, concepts like that. But so if, like I said, if you're here, probably don't care that much about the videos, but since there was no quiz next week, TA was busy with it. He's a student like you, so he's just as busy as you are. He's just gonna do the videos for last week and this week. He's gonna do them later this week, so I'll put those up on YouTube as soon as they're done. Any other questions about anything? Okay. So chapter 21. Last week I did the basics. The kind of vocabulary and foreign exchange, and mostly the big concept was the concept of purchasing power parity that I explained to you, fairly great detail, in terms of one of the ways to look at exchange rate is that an equivalent good should cost about the same in 2 different countries, if assuming that you don't have these other things like transaction costs and barriers to trade and so on. that you have like a free trade area. I did get into interest rate parity and the covered interest rate arbitrage. I'm just going to redo the example just quickly. It's going to take me just 5 minutes. You've seen it last week, but just to remind you what it looks like, and just so that you understand that once the big, really, what we're trying to get to, or what I'm trying to get to in this chapter is 21.5, because this course is a lot about capital budgeting. So 21.5 is how do you look at the net present value of a project when, say, you're a Canadian company and you're investing in Australia or some other combination like that. So you need to come up with what exchange rates you're going to use. So that's why we talked about spot rates. That's why we talked about forward rates and where they come from. So did I start with the covered interest arbitrage? Gives you, I explained to you a fairly great deal what arbitrage meant last week, and it's a finance concept. You're going to use it more once you get into more theory into third and fourth year finance course, but it's a way of, in the theory of finance, to come up with a price that says that price is in equilibrium, and if things go out of that equilibrium, then there's money to be made, and therefore people will make money and bring that price back into equilibrium. Remember the very simple example of how the Rothschild family made their fortune in the UK, where there would be, if you have the price of gold is different in two cities, then what you do is you buy it in the city that it's lower and you sell it in the city that it's higher. What happens? When you buy something, a lot of something, then you create an upward pressure on price, and when you sell a lot of something, you create a downward pressure on price. So that has that's a force that makes the two prices come into equilibrium so that the price of gold is the same in two cities. That was the original first way that trick was played, and that led to the economic concept that a good that's equivalent, because a chunk of gold is the same whether it's in France, the UK, or Canada, right? It's just gold. It's a certain molecule. It's got a certain weight. So it's not like the gold in France is different than the gold in the US. That when you come to covered interest rate arbitrage, what it says we had before this one, the simplest example of an arbitrage I told you was the price in two cities, or just in general. And that gives the basis of what purchasing power parity should be, roughly. Then I also showed you the concept of triangle arbitrage. Now, I don't have examples in the main part of the lecture today, but I am going to have one in my more example section, which is optional at the end. And the purpose, the idea of triangle arbitrage is if you have three currencies, then what is called if you have an exchange rate here, call it R1 and R2, then the cross rate, which is R1 times R2, should be equal to, so R1 times R2 should be equal to R3, this is what's called the cross rate. This is called the direct rate. It's not really called the direct rate, that's what I call it. I'm not sure what the exact technical term is for it. But I showed you last week that if that was different than going through the intermediate currency, then what you could do is what's called the triangle arbitrage, where you start with that currency, you transfer it to this one, you transfer it to that one, then you transfer it back to that one, then you're left with more money than you started with. So that's an example of an arbitrage. And anytime you have an arbitrage in a market, then people are going to say, wow, I love to make free money. And they're just going to keep doing it until the prices get back into equilibrium. So this idea of arbitrage in finance is used as an argument. It's called, I think, APT, arbitrage pricing theory, that prices should be free of any arbitrage, because if there was, then market forces would, people would see the chance to make risk-free money, and they would just do it, and therefore, anytime that prices get away from these equilibriums, they get snapped right back into place. And it used to be, in minutes or hours, and nowadays it's in, milliseconds or microseconds with big bang computers just constantly looking, is the relationship with that currency, boom, 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 and it's a super, super high speed game. So this argument, this arbitrage free pricing argument, is used throughout finance to justify what a price for something should be. So that was the example of the triangle arbitrage. Then the next one was what's called the covered interest arbitrage. So the thing with the example of the gold price, I would say that's the simplest case, right? That's just two prices that should be the same. Then you get into the triangle arbitrage, that's three things that should be the same. When you get into the covered interest arbitrage, it gives you an argument for the equilibrium between the exchange rate, the spot rate, and the interest rate in the two countries. So this covered interest arbitrage thing gives you an argument for an equilibrium between three different numbers, whereas before it gives you, well, it's still, the triangle thing was still three numbers. Actually, no, this one is four, because you got the spot rate, the forward rate, and then the exchange rate in the two countries. So what did it look like? I'll do it a little bit quickly. I'm just trying to review a little bit. If you want to see it in kind of slower motion, you can look at the video replay from last week. So in this, what you do is you start with 100 Canadian dollars. Well, you don't start with, you borrow it. And so that's why the Canadian dollar, that's where the Canadian interest rate comes in, because that's the rate that you can get your money to start your covered interest rate arbitrage. You transfer it at the spot price. So in this case, you end up with, if you transfer it at the spot price of 2, you end up with 200 Canadian dollars, British pounds. If you look at the time scale, this is today, and this is a year from now. Then you invest, you can, that should have been, sorry, I didn't fix it, that should have been RGBP. So you invest at RGBP, which is 5%. So at the end of that year, you're left with 210 pounds. And here's the key thing to understand about this example. The forward rate is not something that you're going to find out a year from now. This is a rate that you can lock in a transaction that you're going to exchange the money a year from now, but that you can lock in today, in the present moment. So that means that by the way, the definition of arbitrage is that all these different transactions, all they're called legs, they all happen at the same time. Because if you looked at the example of triangle arbitrage where you exchange the currency into the other currency, then you wait 2-3 days, and then you go back, that's not really an arbitrage. The definition of arbitrage is where you enter simultaneous trades that balance out to create a riskless profit. And therefore, that shouldn't happen, and when it does, people jump on it, and it snaps the prices back into equilibrium. In this case here, you know that you can lock in this entire trade structure in simultaneous trade, because you can borrow today at 10%, you can change that Canadian dollar into British pounds at at the spot rate. Remember the difference between the spot rate is what you can exchange money today. The forward rate is you lock it in today, but did you have a question? Oh, okay. You know the rate that you can invest today, and you know that you'll be able a year from now to, so the forward rate in this case is 1.8 GBP per CAD. And so you end up with 116.67 Canadian dollars. And then after repaying, so you repay your loan, and you're left with 667 of profit. And therefore, that's where the arbitrage is. And that gives an argument for the exact argument is that the ratio of the forward price to the spot price should be the ratio of the interest rates. So if say the interest rate in the foreign currency is twice what it is in Canada, so say it's 20 in the foreign country and 10 in Canada, then the forward rate should be twice the spot rate, and so on. That's the exact relationship. Then you can rewrite a first order approximation this way. This is called the exact equation, and then if you look, the two are not very different. But what you have to be careful is when you look at a question, at an example, the key word to look for is approximate or approximately or approx, something like that. If it says that, what I'm going to do on the final exam and quizzes is I give the two formulas, and then it's based on, did people realize which one to use. So here, the exact relationship, actually no, that's, the approximate relationship is that F1 divided by S0 is 1 plus the rate in Hong Kong dollar minus the rate in Canadian dollar, the interest rate. And so we know the forward rate, the spot rate, the rate in Hong Kong dollar, so we want to find the rate in Canadian dollar. So we reorganize that equation and write it this way. Then we can plug in the numbers. So you can see that the rate in Canadian dollars should be whatever the rate is in the foreign currency minus the ratio of the forward rate to the spot rate. So that's why I was telling you that the covered interest arbitrage gives you the argument of why, these four numbers, the interest rate in one country, the interest rate in the other country, and then the forward rate and the spot rate, these four numbers have to be in balance so that you have that relationship that in a way, the spread between the interest rates of two countries is related to what the forward premium or the forward discount is between the two currencies, or vice versa. The ratio of the forward rate to the spot rate should be equal to the ratio of the interest rates. And then you just plug in that. Now I'm going to show you how the next one, what the difference between if you would have used approximate and exact. I'm going to do it for approximate, and you're going to see it's not a big difference. But what I do on a multiple choice question is I usually put the two answers, and then you got to know which one to pick. But I'll show you this question if you do it using the approximate equation and using the exact. This is a little bit of review. I think I did that example quickly towards the end of last week. I just want to review because understanding that concept is key to understanding what happens with how we translate things in different currencies when we do capital budgeting. We have cash flows over multiple years in different currencies, and where do the interest rates that we use to convert those cash flows come from? They come from that interest rate parity, which is based on that covered interest arbitrage argument. So this one, if you did it approximate, this time we're solving for RGBP instead of RCAD. And remember, just a quick reminder that in finance, we always give percentages to two decimals. So those are called basis points. So when we say 4.25%, that's the same as saying 425 basis points. So in a written question, I do take marks off for you not understanding that concept. Because when you go to get a job in finance, that's how percentages are done. So I take a 1 mark off kind of thing, but always give, and you gotta know, don't try to be cute and I'm just gonna get more marks and give me 3 or 4 decimals. The correct amount is 2. It's not 1, it's not 0, it's not 3, it's not 4. It's 2. It's always a percentage plus 2 after. So if you give less or more, then you get minus 1 point. So if you did that question, say you got 425, but the answer is 430. That's because it didn't say anywhere there approximately. It just said if the interest rate parity holds. So we want to use the exact equation, which is this one. So we want to solve for our GBP, which is the one here, risk-free rate. Remember that in general, big R means that's the nominal rate, and small r means that's the real rate. So remember the from I think it's chapter 7 that the big rate, the nominal. So this is nominal. This is real. And that's the inflation. And if you write out this, plus H plus RH, but think of this is extremely small. And so that means that you can, what people are used to is that the nominal rate is about equal to R plus H, right? So if you take this equation, you drop out the RH because, you know, if you have, say, one thing is 10%, the other thing is 10%, you're talking about 1%. But if you have like 5% and 5%, you're talking about a tiny little percentage. And then you have 1 plus R on that side and 1 plus RH on that side. So you can say that the nominal rate is approximately the real rate plus the inflation. But this is the additive relationship, but the correct relationship with rate is with multiplication. So that's why that's called the Fisher effect. We'll see a version of the Fisher effect in a second. For this is just a reminder from chapter 7. So big R means the risk-free rate, but that includes inflation and the risk-free real rate. So we want to solve for RGBP. And so you just take that one here. I won't write it as a single line. I can just put it on that side. And so you're left with 4.30%. So now, putting everything we've talked about, you know, the forward rate, the spot rate, and we get to the concept of the unbiased forward rate. So the current forward rate, which is F1, you'll see the important relationship there is the third equation. So the first one that you've seen, the purchasing power parity, we saw that last week. We just did the interest rate parity, based on the so purchasing power parity is based on the arbitrage. You know, you can't really arbitrage a Big Mac. You know, take a Big Mac, buy it in one place and sell it in the other. But still, that concept, the concept of purchasing power parity comes in. You know, for overall an economy, the thing should balance that way. Interest rate parity, it's based on the covered interest rate arbitrage. And then if you combine those two, then what it tells you is the unbiased forward rate. That's not that you combine those two. It's the concept of the unbiased forward rate is if the forward rate is too high, based on what you think that the spot's going to be in the future, then all you got to do is just exchange the enter into a forward contract, and then a year from now exchange it at spot rate in the future. So this argument for unbiased forward rate is that F1 should be the expected value of the spot rate a year from now. Those two things are different. F1 is what you can lock in, what you can, it's a contract that you can enter it today where the money is going to be exchanged into the future. That's F1. S1 is what the spot rate is going to be a year from now, and E is a statistical concept, meaning the expected value, what we expect the average of it to be. So the argument of the unbiased forward rate is that the forward rate today should be what you expect the spot rate to be a year from now. And it's not just F1 and ES1. You know, it could be F2 and ES2, or in general, the forward rate T years from now is the same as the expected value of the spot rate T years from now. So when you combine those three equations together, you get what's called the uncovered interest parity relationship. So those two lines are really just the same. It's just that when you have, if you take the bottom one and you put T is equal to 1, then you have E of S1, and then this to the power 1. And so that's how you get the first one. But really just, all you really need to know is the bottom one. And if you end up with looking at something a year from now, you just plug in 1 into that equation. So we did all of this, all of last week, I don't know, a little bit of this week to get to this relationship. That's probably the most important equation in this whole chapter, because you'll see in a bit. Well, I have a few examples, but when you have cash flows like that, where you're trying to estimate the net present value of a project in a foreign currency, what you need to do is come up with what the rate is going to be that you convert the cash at each one of the years in your cash flow forecast. Well, that's that equation here. This one is what you're going to use. So that's the example here. That you're expecting a payment of 500 PLNs. I think, is there anybody from Poland here? Or that's ever been to Poland? So PLN, I don't know what the N stands for, but I think it's called a zlota, as SZLOTA or THA or something like that. I don't know what the N stands for, because remember, in general, the currency codes are the 3-letter ISO currency codes are the 2-letter ISO country code followed by what the name of the currency is. So that's why you have CAD, Canada dollar, USD, US dollar. Euro is kind of a new one, but just in general, I think, what was it? For example, when you had the German Deutschmark, it was DEM. So DE was the country code for Germany, which is Deutschland. And then you had Mark for M for Mark, and so on. You got Hong Kong dollar, AUD for Australian dollar, and so on. So PLN, PL is the 2-letter country code for Poland, and then N must be, I don't know, must be a Polish Z on a flipped 90 degrees. I don't know. So you're expecting a payment of 500,000 Polish, just call them 500 PLNs, 3 years from now. So you know that the risk-free rate of return is 4% in Canada and 2% in Poland. The inflation rate is 4% in Canada and 1% in Poland. Currently, you can buy 380 PLNs for 100. How much will the payment 3 years from now be worth in dollars? So that's the type of things that when you're running a multinational, you want to know, right? You're doing, maybe earnings estimates, or you're doing budgets, and you're expecting a certain amount of income out of one of your country subsidiaries, and you want to know, when I translate that back to head office, how much is that amount of money going to be worth based on what I know about the forward rates and the interest rate. So here, the expected rate is going to be the spot rate plus the spread between the interest rates So right now, the spot rate is what? 3.8 PLNs per Canadian dollar. Now, because the inflation is higher in Canada than in Poland, obviously these numbers are made up. Usually it's the other way around. But if the inflation in Canada is higher than in Poland, then what you say is the Canadian dollar is at a forward discount and the PLN is at a forward premium, right? Because remember that inflation is the rate at which a currency loses its purchasing power. So if a currency, the whole relationship of interest rate is rooted in the purchasing power of the two currencies over time, as measured by the inflation rate. So if you have the inflation in a country is higher than the inflation in another country, then the currency with the higher inflation is going to weaken faster, is going to lose its purchasing power faster than the other one, and therefore the currency with a lower inflation will go up in value relative to the currency with higher inflation. That's a very important concept to understand, because that's where the idea of forward premium and forward discount comes from. So you can see that in this case, the inflation is 4% in Canada and 2% in Poland. So today you can get 3.8 PLNs per Canadian dollar, and now 3 years from now you'll get 35765. So you can see that the Canadian dollar is weakening relative to the PLN because it's got a higher inflation. So your payment, which is going to be 500,000 PLNs, when you convert it, remember I showed you a nice little trick in that, never knowing if you put the dollar sign in front, or the curly British pound sign, or the funky yen with the double bars in it. If you use the ISO 3-letter codes and you write your equations out like that, it's a lot easier to make sure that you're multiplying or dividing and you're using the right number and so on, because you want things to balance. So I was expecting an answer in Canadian dollars, and that's what I got. Because if I did this, it's very easy when you have multiple things to just flip one fraction and it screws up your whole thing. But if I end up with an answer in PLN squares per Canadian dollar, I know that something's odd. When I balance out my currencies, let me just finish my sentence. When I balance out my currencies that way, I know that I get to the right answer. Yeah. Yeah, it kind of helps. It's just if I want to get the same answer at the end as what's in the textbook, I gotta use that because I gotta use. In fact, I gotta use one more if I wanted to get it exactly equal to 800. Because if I use 3 decimals of precision, I'm only gonna get the first 3 numbers right in the answer. So yeah, for currencies, you're better to use say 4. Yeah. It's just that there's no with currencies. There's no specific. I think when I showed you the example of the interactive brokers trading system, I think they were showing 4. Like the smallest tick for currencies is 4 digits plus a half, right? So you can have 5765, 57655, and 5766. Like there's not 57652. I don't know if you remember that when we looked at the trading board of currencies that I demonstrated to you last week. Each currencies had 4 decimals and then 0 or a half tick. Yeah.
So could you argue that this question is supposed to say worth in Canadian dollars, like just at the last line there? Or is that like part of the test? We have to know which currency we're trying to figure out?
Well, there's no mention of US dollars. Yeah, it's a little bit.
Like if
I'll give that to you that it's vague, but I mean, I didn't give you an exchange rate to US dollars anywhere in that question.
Right,
so
but I mean,
obviously that means that it should be Canadian dollar. It's not quite clear, but it's like 99% clear, which is clear enough as far as I'm concerned.
Okay.
Yeah. Obviously, yeah, I'm not trying to trick you into do this whole thing in Canadian dollar, but we want an answer in US. That actually meant what is it in Canadian dollars? So you multiply that, you get 139. I'm not that difficult with how many decimals you use for exchange rate, but I am pretty difficult for how many decimals you use for a percentage because that's the way that bonds are quoted and that's the way that the market works. Anything that's interest rate related always works in basis points, but exchange rates, it seems to change from year to year. It used to be 4, but now they added that half point. So I'm not going to be that difficult. Just in general, I suggest that you use 4 decimals. But it's not something I'm going to, if you only use 2, I'm not going to be taking off marks. So if you take purchasing power parity, which is the relationship between, which is that one, where is it? If you take that first equation at the top, ES1 is S0 plus the difference in the inflation rate, and you combine it with the one at the bottom, which is ES1 is S0 plus the difference in nominal rates, then you can just put them together and you get that the spread between, well, really that's the approximate the better way to say that is the real rate of return between 2 countries must be equal. And then if it wasn't, then people would be doing this covered interest rate arbitrage between the exchange rates and the to bring these things back into play. This is a very important concept because this is another thing that we use when the last one, this one, is the relationship that we use when we're trying to when we're doing what's called the home currency approach, where you convert each, well, you see in a second. I might as well just get into the thing and then you see how it's done. So this is the international Fisher effect. It's similar. It's a similar relationship to the regular domestic Fisher effect for interest rates, but this is how it's applied when you look at the the spread between the inflation rates and the between the interest rates and the inflation rates between two countries, they should be equal. It's just a simple one here. So there you are. The Deutschmark shows up here. You know, it's a dead currency. It doesn't exist anymore. So here we know we're looking for the inflation rate in Canada. We know the interest rates in the two country and the inflation rate in Germany. So we just need to reorganize that equation for what we want, which is HCAD, which is gonna be RCAD minus RDEM plus HDEM. All right, here's a nice spot to take a break. So I have 7:02 on my watch. You guys always like, all right, so let's continue. Sorry, I ended up taking a little bit more time. I had lots of questions at the break. So now, everything we've done so far, everything we've done so far was leading to build up to this point. Because this course is about looking at projects and decided if you should do them or not. So estimating the cash flows and then figuring out a net present value for the decision. Like almost every chapter that we do something, there's a lot of different chapters. They're more or less the same concept, right? That's what's going on in chapter 10. That's what's going on in chapter 11. You know, chapter 14, you're doing it so that you know what discount rates to use for that net present value calculation. Chapter 15 is more, just knowing how to raise capital, and a little bit stands on its own. Chapter 16 is about more of a theory thing of how capital structure works. 17 about dividends. But then we get, for example, next week 22, where we do leasing. We still have that same thing where we have cash flows over a number of years for the project. And then, well, I'll give you the punchline in advance. When you look at the leasing decision, you look at the net present value of leasing and the net present value of owning, and you take the cheapest. Well, you actually do as the difference of the two. But this concept of looking at a certain number of years for our financial analysis that we're looking at, estimating cash flows for that period, and then figuring out a net present value. That kind of pattern shows up in 10, 11, 21 and 22, and in fact, I think a little bit, it's to some degree in 23 also. So the challenge is in chapter 21 is how do you do this when you have different currencies? It's very simple so far. Everything we've done was always in a single currency, and it was always, you basically looked from the point of view of a company, and you looked at the net present value of something based, and all the expenses were in the currency that the company has their financial statements in. So there's no, foreign exchange and forward rates, spot rates, anything to worry about. When you do net capital budgeting or net present value for a multinational, then the extra complexity in it is that you have cash flows in one currency, but you want to know what is the net present value of these foreign cash flows in my home currency. So there's two ways to do it. The first one is called the home currency approach. The second one is called the foreign currency approach. The home currency approach is a little bit more complicated than the foreign currency approach, because with the home currency approach, what you do is each cash flow that you have, you convert to your home currency, and then you do the net present value that way. And so you got to figure out, what is the exchange rate that I'm going to translate all my future cash flows into, using what rate, and at the same time then, so I'll have a different exchange rate for each period, and at the same time I'll also have each cash flow will be worth something different because it will be translated at a different exchange rate. With the foreign currency approach, it's a lot easier, because what you do is you just do your entire net present value problem in the foreign currency, and then when you get an answer in that foreign currency, you just convert it to your home currency at the spot rate. So the home currency is a lot more complicated, but I'll show you both. So with the home currency approach, first you estimate the cash flows in that foreign currency. Then you estimate the exchange rates for each of the future cash flows at each of the time period, using what we've done so far. UIP is this equation, right? EST is the spot rate times the spread between the foreign interest rate and the domestic interest rate to the power of how many years you're looking forward. So you figure out the exchange rate at each future period. Then you convert each one of those future cash flows into your home currency, and then you roll it all into a net present value, because now what you have is a series of cash flows in your home currency, and then you just take the net present value of that. So let me show you an example. Okay, you have a new project in Mexico. So your investment, your cash flow in year 0 is 9 million pesos. The cash flows are expected to be 2.25 million pesos per year for 5 years. The current spot exchange rate is 9.08 pesos per Canadian dollar. So what we're going to need to do is, so we already have estimated the cash flows in the foreign currency. That's just given in the text of the question. So now what we have to do is figure out what is the expected spot rate of each of those 5 years. So that's the longer part. Now, one concept that you got to look at that's useful with that kind of question is if you look at that equation, EST is S0, 1 plus the rate in the foreign currency minus the rate in the Canadian currency. Say if I was looking at ES2, then that's really, I'm just going to call this, big square, right? So I just don't want to write it a second time. So if you have, well, actually that makes, because then I'm going to say square, that's too confusing. Let me just, I'm going write it out in full. Right, if I write out S0, so ES2 is S0 times the difference between the interest rates to the square, to the second power. If I write this out that way, well, what is this here? That's ES1. So that's ES1 times so in general, you know, I could show you that in general. You end up with that EST plus 1 it's right to when you're doing this uncovered interest parity to estimate the future the expected value of the future spot rate. Now I won't give you this as an equation in on a formula sheet, but you should just from seeing that you should understand that to begin with. The reason why that's useful is when you're trying to find, when you have to estimate the expected value of the spot rate a bunch of years from now, instead of having to do, you know, this to the first power, and then this to the second power, and then this to the third power, and this to the fourth power, all you do is you take whatever it was for the year before, and you just multiply by that. And so that's how you can, that's a much quicker way of getting your, you know, if you're writing a written question, that's a much quicker way of finding your forward rates. Instead of having to write out the full thing, you know, with to the first power, then the full thing with the second power, the full thing with the third power. It's a lot easier, it's a lot quicker to do it this way. So I start with my first one. I'm just going to start with so 1 plus, so the currency code for Mexican pesos is MXP, right? So MX for Mexico and P for pesos. And so let's see what that is. It's the risk-free rate in Mexico is 8. The risk-free rate in Canada is 4. So that factor is going to be 1.04. Right, so if I want to do my ES1, that's going to be the spot rate. So you just do it for the first one. The spot rate's 908. And then that's multiplied by 104. So instead of having to redo this whole thing, each, yeah?
How do you know when you use the approximate one versus?
When you're doing capital budgeting, you're just using the, actually, approximate versus exact. When it comes to the UIP, that equation, you always use that one. There's no, the relationship where you had an exact or an approximate was when you had F1 there, not expected value of S1. So what, it's because when you have an expected value, it's approximate anyway, right? So, does that make sense? Think of it in statistics, nothing is ever exact. So because this is a forecast, this is an approximate value, that's why you're using the approximate version. So now instead of having to redo this for ES2, ES3, ES4, and so on, all you got to do is take the previous one and multiply by 104. So ES2 is going to be 94432. And so on. You got next one is 1031. Sorry, 1021.38. That's equal to 1062. So you can see that because the interest rate in Canada is 4% versus 8% in Mexico, then the Canadian dollar is at a forward premium to the Mexican pesos, vice versa. The Mexican pesos is at a forward discount to the Canadian dollar. So you can see that as you go forward into the future, the Canadian dollar is stronger, right, because it's at a premium. So 5 years from now, whereas today you can only get 9.08 Mexican pesos for 1 Canadian dollar, 5 years from now you'll be able to get 11 pesos for a Canadian dollar. So that's very important when you're doing capital budgeting like that, especially maybe in, say, emerging countries where you're expecting fairly high inflation rate. There's always, well, nowadays it seems that the U.S. and Europe are just as bad with inflation.
I'm a little bit confused. Are you doing each year just so you can show like us how it increases every year, or like can't you just?
No, because I'm going to need all those numbers, because I remember the home currency approach is I got to figure out what is my expected value of the spot rate for each one of the forward years, because I'm always making 2.25 million pesos each year.
Okay.
But in Canadian dollar, you'll see it in a bit. Let me continue.
Okay, gotcha. You have to involve the numbers.
So the cash flow in year 0 is going to be minus 9 million Mexican pesos. That's 238, 267. Well, I'll spare you doing every single one, but you're starting to see the pattern, right? For each one of the forward years, so the cash flow in year one, the cash flow in the foreign currency always stays the same. But because the exchange rates over time are changing, the actual value in Canadian dollars of each one of those fixed Mexican pesos cash flows is decreasing. So I'll spare you the one. I'll just show. So CF3 is 220, 291. You just keep applying this with the progressive other rates. CF4 is 211, 818, and CF5 is 203. And this shows you the risk. Yeah.
Where did you get the 220 from?
In the question, the cash flows are expected to be 2.25 million pesos a year for 5 years.
So each year we multiply 2.25 times the percent, or?
Well, whatever, in that question, yes, it's 2.25, but it could be a different amount. It depends what the question tells you. Right? In that question, you're making 2.25 each year. It could be like, that question is not, like, it could be you have a different questions where it's telling you that, I think the next one is like that.
Like you multiply with the top rate, or?
I think I have a, see, here's an example of a home currency approach where the project is, the cash flow in British pounds is 8,000 the first year, 22,000 the second year, and 20,000 the third year. Well, in that case, you're not using the same number each time, right? You would convert 8,000 at the forward one rate. You would convert 22,000 at the 2-year rate. You would convert the 20,000 at the 3-year rate, right? It's whatever the cash flow in that foreign currency is for that year, multiplied by what the expected value of the spot rate that year is going to be. And you can see that when you're operating as a multinational in a country where there's a very high inflation and you're earning your income in that your cash flows are in that foreign currency, but you have to bring them back to your home currency. That's the risk for a multinational to invest into a foreign country where there's a very high inflation rate. It's because when you look at the net present value of your project, if you're talking sometimes like, mining projects, oil and gas projects, sometimes are like, 10, 20, 30 years. Or you build a pipeline, that could be like a 50-year investment. So if you're expecting a lot of inflation in that foreign country, it's really the further and further, look at this, the spread between the risk-free rate, which is really the same as the spread between the inflation rate, is a whole 4% between Mexico and Canada in that example. So you start in the first year, even though in the foreign currency you're always making the same amount, the first year you're making 238,000, but by the 5th year you're only making 200,000. So a project that might look great in the first year of operation, when you look at the fact that over time, because the foreign country that you're operating in might have a much higher inflation rate than your home country, once you look at that, then over time, that foreign inflation rate is going to eat up all your profits, and it's going to convert a project that might look pretty good to begin with into, if you had like an exchange, a forward, if you had a foreign inflation rate that was very high, then by the 3rd or 4th year of the project, all your profits are gone. So the net present value of your investment is not going to look so good in your home currency. Because remember that from the point of view of a multinational, you report your earnings in of the currency of the country that you're in. So you're an American company, you report in U.S. dollars, and you're a Canadian company, you report in Canadian dollar, you're European, you report in euros, and so on. So if you're investing, say, I don't want to pick on any emerging country. So what's the country that Borat was from?
Kazakhstan, yeah.
Well, Kazakhstan, that's a real country though, no? So I was hoping to find like a fake country I could rip on. But if you, as a multinational, you're investing into a foreign country, well, here's an example of a country that has a stupidly high inflation rate. I think it's Zimbabwe. So if you're investing in that country, you might invest in that country, and in the first year you'll make a profit, but by year 3, 4, 5, because of the spread between the inflation rates, if you're investing into a country where there's a very the currency of the country of the foreign country you're operating in is at a very strong forward discount to your home currency, then the actual net present value, once you calculate it in terms of the currency of your home company, is really not so good. In that example, it's not that bad because you only have a 4% inflation rate spread between the two countries, but that's still pretty high. It takes, once you repatriate your foreign cash flow into your home cash flows, in the first year you're bringing home 238, but by the end you're only bringing home 200. Well, that's what, like 40, that's a 20% drop in cash flows in terms of your own currency over 5 years of the project. So once you have the cash flows for each year in your home currency, that's why it's called the home currency approach. Yeah.
Okay, so what I was asking before was, when we're trying to find the expected value of S, you wrote it down like each separate line and all that. Like, I understand we have to use each separate number to calculate the cash flows, but can't we just use the power button on our calculator instead of just writing it out? Writing off?
Well, you gotta give me one line for how you calculated each one. If you want to write it this way, ES1 and S0 times that, then ES2 is S0 times that to the square power, E0 is S to the third power. You can do it that way too. It just takes a lot longer.
Okay.
Right?
No,
It's just a lot quicker to take whatever the spot rate was from the year before times what that factor is. That's how you get the next one. It's just a lot quicker. You don't have to do it that way. You can do it the long way if you want. You'll still get full marks either way.
No, but I didn't say I wanted to do it the long way. I just wanted to write the answer down. But you're saying you have to write the formula down first.
You just have to write something, right? I mean, I don't want to get an answer where somebody just tells me, oh, that's just where I got all my 5 forward rates. What tells me that you didn't look to the person next to you to copy them, right?
Okay,
That's one of these show your work questions where you got to tell me, well, if you're saying that 10.6223 is the spot rate in year 4,
right.
where'd you pull that number from? Right? Either you did it by stepping in it forward 1 year, or you did it by figuring out the full way for each year. Either way, you got to show me something. You can't just say ES4 is equal to 10.6223. How do I know you just didn't copy it off somebody else? Right?
Okay.
So, first you figure out all the exchange rates, then you figure out all the cash flows into your home currency. Then once you have that, you're back to just the net present value. And then you can just use for that one, you can just use the Canadian dollars. You're done with the currencies by that point because you know everything into your home currency. So the first year is minus 991,189. Then it's 238. 267 discounted 1 year, 229 103 discounted 2 years. And so you end up with a total net present value of the foreign currency approach is a lot easier. All you do is you estimate the cash flows in the foreign currencies, but then here's the other twist to the only complication in the foreign currency approach is what is the discount rate that you're going to use. Remember that in the home currency approach, what you do is you convert all your cash flows into your home currency, and then you do the discounting, the net present value stuff, in your Canadian currency. In the foreign currency approach, you do your net present value using the foreign cash flows. But the foreign cash flows, you don't discount them at the Canadian interest rate. You got to discount them at what the rate is in the foreign country. That's where the complexity of this comes from. In the home currency, you're using your home rate to discount the cash flows. In the foreign currency approach, you got to figure out, because they're the cash flows are in the other currency, you got to discount those cash flows in using the foreign discounted return, not the domestic discounting return. And then, so instead of converting all your cash flows and then discounting at the home return, what you do is you discount the foreign cash flows using the foreign return, and then you have a present value amount in foreign currency, and then you just boom convert that at the spot rate. So I think this is the same as the this is the continuation of the Mexican example. So the inflation rate. So if the real rate, if the risk-free rate in Canada is 4 and the risk-free rate in Mexico is 8, then the Mexican inflation rate is 4%. And so the required return was 15% in Canadian dollars, but because the Mexican pesos has a higher inflation rate, then the proper return to use when you're discounting Mexican pesos cash flows is 19%, not 15%. So it's whatever the home return is plus what the foreign inflation is. So the present value of the future cash flows, well, that's just that 6879. That's that right there. That would be the present value. Because it's an annuity now, it's a lot simpler. it's the payment times 1. So the payment's 2.25 million. That gives you 679 Mexican pesos. So that's the present value of the inflows. So the net present value is the present value of the inflows minus the present value of the outflows. So the outflow is the initial investment of 9 million pesos. So the present value of that project in the foreign currency is minus 2.1 million pesos. And so remember that a present value is what something is worth today. So then you just convert it at the spot rate of 908. And so the net present value using the foreign currency approach is minus 233 Canadian dollar. It's not that far from what we had from the home currency. Using the home currency approach, we got to minus 243, and using the foreign currency approach, we got to minus 233. They shouldn't be, that far off. It's probably just the accumulated errors of, rounding at each step of the way. So let's do an example of the foreign currency approach for Australia. So remember that the first step is to estimate the cash flows in the foreign currency. But in most of the question, it just tells you what they are. So the cash flows in the foreign currency are minus 2.3 million AUDs to start, and then plus 950,000 AUDs each year for 3 years. And then the project will be worthless after the first 3 years, meaning that there's no salvage after that. So it's not a perpetuity. It's just an annuity of 3 years. So it could be you got like a 3-year license maybe to operate a mine or something like that, and after that it goes back to the government. Or this is just something where you don't have residual value after that. So next we know our cash flows in the foreign currency. We got to discount those using a interest rate that's relevant to the Australian dollars. So we're not given that. We're given a required return in Canada, and then and the expected inflation rate in Australia and in Canada. So you start with the international Fisher effect. So the rate in Australian dollars is going to be the rate in Canadian dollars plus the spread between the inflation in the two countries. So if you look at if you discounted cash flows in Canadian dollars, you would discount them at 6%. But because in Australia the inflation is higher, you need to compensate investors for that extra inflation. So the appropriate required return when you're looking at Australian dollar cash flows is 9% instead of 6%, because it's the 6 plus the difference in inflation between the two countries. So now you just discount the cash flows. So the net present value is going to be so that's going to be plus, so it's not 5, it's 3. Now, you would write out the equation that way, but when you do it with the cash flow feature on the calculator, all you got to do is CF0 is minus 2.3 million, CF1 is 950,000, frequency 1 is 3, and then boom, you're done. So you could also do it using an annuity. So then you get to so now what you have is what is the net present value of that project in, you could call it net present value in Australian dollars. That project in the net present value is 104,730, and so then what I can do is my net present value in Canadian dollars is going to be 104,730. And convert it at the spot rate. So the spot rate is 86 Canadian cents for 1 Australian dollar. And so the net present value in Canadian dollars is 90,000. Okay, so here's another good spot to take a break. Okay, so let's continue, please. I only have a couple of qualitative text slide to go through, and I'll be done for the day. And then I got like 3 or 4 more examples, which are optional, so you guys can stay or not. It's up to you. So repatriated cash flows. When I did the home currency approach, we basically looked at it as if the cash flows that you made each year, you were allowed to take them out of the country and bring it back home. There's now the textbook it looks at how do you actually move that cash flow around. Okay, so you made 200,000 in Mexican, or you made like 2 million Mexican pesos. Well, that one would be quite simple because Mexico, Canada, and the U.S. have NAFTA, so you don't have a lot of legal restriction on movement of goods and movement of capital. But you have some countries which have, I think China has limitations on stuff like that, where a foreign company can't just make money in the country and then just take it all out. I can't remember. It's the way that they control the currency on how much you can transfer and so on. But if you're allowed, how does it happen? Well, you can have each country, so it could be set up like this. You have a multi-co, so I'll call it like a multinational. And then you have a company incorporated in the US called US Co. A company called incorporated in Canada, say call it CanCo. And say a company in the UK, UK Co. So it's not, you think of say like a single company, so you'll call it say, Hewlett Packard. It's actually not just one corporation, it's many, many different corporations and then in each country that you operate, you incorporate a company under the laws of each of those countries, and then each of those companies make money in those foreign countries, and then they kick up dividends to the parent company. That's why you have tax-free intercorporate dividends. This is in the setting of multinationals. Just sorry for going just off topic, but there's you can look at that, search it if you're curious. Even within a single country, or sometimes even like this. The holdco, opco, reco structure is very common. That's not on that, but just for you guys to be aware of. That's how a lot of companies actually operate. You have a holding company, you have an operating company, and then you can have a real estate company that owns the real estate. But to give you the example of how I run my business in Gatineau, it's actually just the holding company owns the real estate itself. The reason why you split that is if you have an operating company that's engaged in risky activity, or that can just, everybody can get sued, or something bad can happen. Well, if somebody sues OpCo, they can't take your real estate because it's not actually, if somebody sues that company, that corporation doesn't actually own the building, and so the judge can't say you run a restaurant and one of your waiters just dumps coffee and burns a client. That client sues you for $1 million. Your building, say, is worth like $1.2 million. Well, you can't have the judge say we're just going to sell the building to pay the claim, because that person would be suing OpCo, not HoldCo. So this OpCo, HoldCo, OpCo, and sometimes you got a corporation in between the HoldCo and the real estate RECO. That's very common how private companies are structured. So when you look at, each one of those might have other corporations. It might have, say, different divisions. CO1, CO2, CO3. So the reason why intercorporate dividends, so where the dividend is paid from one corporation to the other, as opposed to the dividend is paid from a corporation to an individual. The reason why these intercorporate dividends are tax-free is so that you can set up these structures, and then every time you consolidate your income into the parent holding company, you don't get dinged 20% at each step of the way. But that's what dividends to parent company, that's how it's set up. You have a global corporation. A lot of times companies set themselves up in Cayman Islands or someplace like that where you don't pay any income tax, and then you incorporate companies in each one of the operating jurisdictions that you have, and in each one of those corporations, these country-specific corporations make their profit, and then they kick it up to the parent in the form of dividends to the parent company. The other one is management fees for central services. So you can have, for example, that each one of these companies is going to pay the parent company for providing, like a global accounting system, a global, IT system, and so on. Royalties on the use of trade names and patents. So it could be, say, an example would be, McDonald's. McDonald's doesn't, the corporation that's traded on the stock exchange doesn't actually own every single McDonald's around the world. A lot of the McDonald's around the world are franchises, and so each one of the locations pays what it's a royalty to use the name McDonald. And I don't think they, much of a patent on a hamburger, but the royalty is either a fixed amount per month or it's a percentage of sales. So it's common, like for example, Tim Hortons I think is like 5 or 10% of sales have to be thrown to the parent. So what you can have is you can have the companies in each countries, they pay a royalty on what they do on their sales to the parent company, or they pay a dividends, or they have a management fee. And then there's another thing, it's not in the slides, but this is a very important topic in tax. It's not covered in this course, but it's called transfer pricing. And that has to do with, say you have the way that companies operating in two different countries, the way that they can kind of play around with the tax system is, say the company in the U.S. manufactures a part that then gets sold to a Canadian subsidiary that then takes that part and makes a product out of it. Well, whatever that price that you use for what the related, say, so these would be, say, dividends, but you might have that US Co. makes a product and sells it. So it could be like, usually between US and Canada, you have where there's a company in the US that's manufacturing, and then there's a company in Canada that doesn't build any of the things. All it does is it distributes and it sells it. So you might have, say, a bicycle company that's a global company. It's got operations all over the world. They manufacture their bicycles in the U.S., but they sell them in Canada. So you have a Canadian company. All it is, it's basically a wholesaling operation, right? It buys the bicycle from its related subsidiary in the U.S., and then it takes those bicycles and then sells them to Canadian Tire and Play Against Sports sells new stuff. Like the different sport experts, all these different places. So what is the price? What is the price that you should, because the company controls what that price is. It's not a real market price in that the Canadian company is not going on the market and buying bicycles from an arm's length other unrelated company. The decision is all made within the single, big corporate structure. And so what is the price that you decide? Because obviously if the taxes are higher in one place than the other, then what you do is if the taxes were higher in US than Canada, then what you do is you want a lower price that the Canadian company is paying the US company. And vice versa, if the taxes were higher in Canada, you want the Canadian company to pay as high as a price as possible to reduce the amount of profit that's going to be claimed in the different jurisdiction. That's a big, important tax topic. It's not going to be covered in this course, but you'll hear that expression. If you do international business, where you have global operations of a single company, and you're related to tax, you'll hear that expression a lot. I'm not going to ask about it though in an exam. Transaction exposure is, and a lot of companies get run into problems with that. In fact, the first company I ever owned got killed by that. I owned a record store where I was buying records from the UK and Germany, and I was selling them into Canada and the US. And then all of a sudden, the Canadian exchange rate started going up like crazy relative to the US dollar, and then at the same time, the price of the euro was going down. And so what happened? Whereas before in Canadian dollar, I was buying at 7 or 8 Canadian dollar and selling at 10 US and 15 Canadian. All of a sudden, the Canadian dollar went to parity with the US dollar, and the euro went the other way. And where I had a nice business model where I had about 50% markup, 30%, 33% margin. All of a sudden, my gross margin went, it got squeezed from both sides and went to zero. So that was the end of my record store. And it was just based on, we were still selling, we were still pretty popular. It's just that, the currencies just, the relationships that had existed, that happened around 2001, 2002. There was kind of a big, the British pound to the Canadian dollar went from like 2.3, 2.5 to like 1.6 within a year or so. So so basically, my whole business model collapsed. This is the kind of risk that you have. Obviously, I was much too small. I mean, we're only doing like 100,000 or so of sales out of my basement. It wasn't like a crazy business where I could go see like J.P. Morgan and get a forward exchange rate, a derivative contract to lock in my rate, 5 years into the future. But this is just, I'm just giving you an example of my own life, but to show you that that's the reason why companies want to use these foreign exchange contracts, these forward contracts and swaps, because it allows you to lock in the rate of what your future profits are going to be. And so if the rates change a lot all of a sudden, it doesn't completely destabilize your company, where before, your company might have been making $1 million a year, but all of a sudden, the rates change, and the great business that was making $1 million a year, or you were expecting to get $1 million a year for that year, but you've paid your employees that at headquarters the whole year based on what you expected to receive from the foreign country at the end of the year, and all of a sudden over that year the exchange rate changed like crazy, and you're not getting as much money anymore, and now you don't have enough money to pay your employees or your creditors, and you go out of business. So managing risk is entering into these derivative forward contracts, where if you're a corporation where you know what you're going to be bringing in back and forth between two currencies over time, what you want to do is you want to lock it in. You want to lock it in using these derivative contracts, usually a forward or sometimes a swap. And that way, you protect. You'll pay a little bit. You'll pay maybe 1%, 2%. You'll lose maybe 1%, 2%, maybe 5% at the worst of what your profit's going to be. But at least for sure that you lock it in. It's not that I expect to be making $1 million this year, and the exchange rate drops by like 20%, and all of a sudden I'm making $800,000. I'm bringing home $800,000 instead of $1 million, and I don't have enough money to pay my costs at home anymore. So that's how you manage risk between currencies, is by using this, by using these forward contracts. The problem is that you can't do this over very long periods, because the further into the future you go, the more the banks are going to charge you for protecting you against that risk. So it gets to a point, usually, past 2 or 3 years, this is the same with hedging, hedging, say, input costs, agriculture commodities, say for a food processing company, or maybe oil for an airline. Past 2 or 3 years into the future, the banks will charge you way too much for that hedge, because it's pretty hard to figure out what the oil price is going to be, say, 10 years from now. And so if a bank's going to write a derivative contract to hedge your risk, on a derivative contract, you're transferring the risk from one person to the other. And so if the bank's going to take the risk of where the exchange rate's going to be, say, 4 years from now, 5 years from now, or 10 years from now, it gets to a point where the advantage of protecting your currency risk versus what it's going to cost you to protect that currency risk too far into the future becomes much too high. So then you have that exposure, that risk to general economic conditions. So remember that exchange rates move mostly related to inflation rates and their related interest rates. And so these are, you've got to be really careful when you're looking at an international business, at a project that's many years into the future. Because the relationships between the currencies that exist today might not be the same 5 years from now. There's a good point, very good point that's made on that slide, and it's the last one. One of the ways to mitigate this risk, you can hedge for fairly decent cost on a 1, 2, maybe 3 years out. But the best way to hedge, to protect yourself against these imbalances in currencies over time, is to borrow in the foreign country instead of using capital for your home country. So if we go back to the example we did earlier, where we were we're a Canadian company, say, doing something in Australia, instead of taking money that we raised in Canada and then converting it to Australia, doing the project over there and bringing it back home, it might make more sense to raise our capital in the market that we're using that capital. And because if things go out of balance, well, at least you're not stuck with making money in one currency and having to pay your bonds, having to pay your creditors in a different currency, and then the exchange rate goes off balance, and then you don't have enough money to pay your creditors in your home currency anymore, because you're not making enough once you translate it back. If you're borrowing or raising equity in the country that you're doing the investment in, then you're not exposed to that foreign exchange risk. Because if I'm borrowing I'm a Canadian company, but I'm operating in Australia, but I've borrowed from an Australian bank. Well, if the Canadian dollar and the Australian dollar, like that exchange rate, moves like by a large amount, it makes no difference, because I'm making money in Australian dollars, and I'm paying my creditors in US dollars. So I don't have to bring it back to my home currency, which might be worth a lot less, and then I don't have enough money to pay back in it. So that last point in that slide is actually pretty important. Now, translation exposure, there's that's more accounting, so you can just ignore that slide. I'm not an accounting guy; I'm more of a finance guy. But all this slide says is, it's a real mess when you have to account for stuff in different currencies. Because a lot of times when you look at earnings of a company from one year to the other, and they move, like, the analysts are going to say, oh, the company's going to earn a certain amount, and then, or the company says, they have their own forecasts, their guidance, that they say we're going to earn a certain amount, and then it's a big, huge difference. It usually has something to do with currency. You know, like, oh, we made a lot more money this year because, you know, this foreign country that we had an operation in, all of a sudden the exchange rate went up, so we got a lot more back in Canadian dollars. Or vice versa, well, we did really well in that country, but, you know, the Canadian dollar relative to that currency, you know, went way down, and so in Canadian dollar we didn't make as much. And then earnings per share and all kinds of accounting regulations. That's more of an accounting concept. I'm not going to test you on that, but just be aware that it's a real. It could accounting, multi-currency accounting can be a real mess. Well, I've really talked about that already. Hedging individual currencies can be expensive. Sometimes you hedge something, but things get out of hand, and what started as a hedge ends up the other way, because if you don't keep your hedge in balance over time, that's what happened with that big mess. I think it was J.P. Morgan again, out of the London whale story. It started with a hedging thing. I don't know if it was currency or interest rate or some other thing related, and then it just got out of control, and they lost like a pile of money. But all this to say that hedging can be complicated. It's doable over, and it costs, the costs are lower than the risk over short periods. But the further you go into the future, the harder it is to do. Now, political risk, I'm not going to talk about that so much, but you know, there's a lot of crazy dictators around the world. You know, and you know, you make an investment into some, you know, emerging country, and then all of a sudden, you know, you get like a guy like Chavez, and you just say, oh, thanks for building this this oil well in our country. It's ours now, and if you don't like it, here's my army. You know, with their guns in your face, and get out of here. So, you know, political risk is always an issue. Obviously, this is not something that I'm going to teach you in this course, you know, very well. You're going to learn more in kind of international business type of courses, but you know, tax rates can change. You can have, you know, these kinds of expropriations. You know, a lot of people invested in Russia when the Soviet Union first broke apart. And a lot of people went into Russia, and then a lot of people lost their shirt because there was a lot of corruption, and you know, the government would just take over a company and so on. All right, so I'm at the more examples section, so feel free to leave. I'll just take a short 5-minute break to let people clear out if you want, and then I will just do 4 examples, and then we'll be done for the night. All right, so 4 little examples. So the first one is, you can buy, whoop, it's better. You can buy 245 Canadian dollars with 100 British pounds. So the exchange rate is 2.45 CADs per GBP. How much profit in US dollars can you earn on a triangle arbitrage given the following rates if you start out with 100 US dollars? This is where, you know, my currency code trick to, not really a trick, but a method to do it makes it easy. Because you look at all these numbers, am I multiplying by this, am I whatever? If you do it this way, it makes it pretty simple. So I start in US dollars. Then I'm going to convert to Canadian dollars. Then to British pounds. And back to US dollars. So I start with 100 US. So I get 1.35 Canadian dollars per US dollar. Then, so that's to go from here to here. Then to go from Canadian dollar to British pounds, I got 100 British pounds for 245 Canadian dollars. So now I will have an amount in British pounds. And then I convert back into US dollars. At the rate of 1.8305 US dollar for 1 British pound. And so I'm left with, sorry, you start with 100. You end up, okay, my notes are not, so. So you end up with 186 US dollars. And so British pound cancels with British pound. You get an answer US dollar, which is what you're expecting. Canadian dollar cancels Canadian dollar, US cancels with US. So that we start with 100. We finish with 186. So the profit and remember that if you did this way, and say you ended up with 99 US dollars, then what you would do is just do it the other way. Say if I do my triangle arbitrage clockwise and I end up with less money than I started with, then if I do it counterclockwise, I'll end up with more money than I started with. If I end up at the exact same amount, then there's no triangle arbitrage, right? Then in that case, the cross rate and the direct rate are in equilibrium. When they're not in equilibrium, either by going clockwise or by going counterclockwise, one of those two, one way is going to be less and one way is going to be more. The second one is the current spot rate between the Australian dollar and the Canadian dollar is 1.015 per Canadian dollar. The rate on Canadian T-bills, so that's a measure of the risk-free rate in Canada. So our CAD is 5 and our AUD is 10. What is the 1-year forward rate if the interest rate parity holds? Another way to say that would be, what is the 1-year forward rate if there are no covered interest arbitrage opportunity? So in this case here, that means we have the exact interest rate parity equation. So F1 is S0. Well, normally it's written as F1 divided by 0, but I'm just going to write it as F1 is equal to S0, 1 plus R AUD divided by 1 plus R CAD. So the spot rate is 1.015. So then if the spot rate is 1.015 and the Australian dollar is at a forward discount, then you will get more Australian dollars in the future for the same amount of Canadian dollars. So the forward rate in 1 year is going to be 1.0633. I only have 10 minutes left, so I'll skip this International Fisher effect. It's super simple. This is the one I want to do. So this is the home currency approach. So what I got to do is at first know what estimate what my cash flows in the foreign currency are going to be. That's just given in the question. So I know that my foreign cash flows are going to be minus 45,000 pounds, and then plus 8,000 pounds, plus 22,000 pounds, plus 20,000 pounds. So first I gotta convert those future cash flows in British pounds into future cash flows in Canadian dollars. To do that, I gotta know what the spot rate's gonna be at each one of those 4 years. And so ES2 so that's just 0.055 minus 0.045, that's 0.01. So that's times 0.01. And then instead of doing the cash flow separately, you can just write it straight into the NPV equation. So obviously that's your cash flow in year 0. So it's divided by 1. What's the 10.5? So the first one it's not discounted. So the cash flow in the first year is converted at the rate of 5757. And that's discounted back 1 year. That's going to be pretty tight for space. continue on the second board like I did before. Then you got the cash flow in year 2 is 22,000. So that's converted at the rate in year 2. The expected the spot rate in year 2. And that's discounted back 1 year. 2 years. So that one was to the power 1, that one's to the power 2. Gotta make sure I don't go off my. So the cash flow in year 3 is 20,000 pounds. That's converted at the rate in year 3, which is 5873. And that's discounted back 3 years. So everything's equal to, so the cash flow in the first year plus the cash flow in the second year converted and discounted plus the cash flow, the cash flow in year 0, so the initial investment, just converted, well it's discounted to year 0, so it's really just divided by 1. Plus the cash flow in year 1, converted at the spot rate in year 1, discounted back 1 year. Plus the cash flow in year 2, converted and discounted 2 years. Plus the cash flow in year 3, converted at the rate of the exchange rate of year 3, and discounted back 3 years, and you end up with net present value of minus 10,144. Yep.
Is it a full year because it's third and final?
It just means that the third year is the last one. It doesn't mean that you got 20,000 and 20,000. It just means that the third year is, it's just an expression, the third and final year. Meaning that that third year is the final year, meaning that there's no fourth year.
The MPU is 45,000 times 1 divided by 0.5815. Why not?
Oh, sorry, I think I got a mistake there. No, the spot rate is 0.5. Yeah, no, that's right. That's a mistake in my notes. 5757, 5815, 5873. Yeah, no, that one here, that should be 57. You're right. All right, that's it for today. I will see you next Tuesday.